Okay, going to get started on the investment panel. Thank everybody for coming this afternoon. First, I'll just introduce myself as the moderator. I'm Franklin Olakunle-Amo. I am a founding partner and managing partner of something called LBS Emerging Markets. We're a private equity firm that invests growth equity in manufacturing and industrial companies across Africa. And I have the sincere pleasure of chatting with probably about as premier as you can get a selection of investors on the African continent today. So these are the guys actually doing the deals that we're reading about. So you've got a pretty big treat. So may I quickly ask everyone going around? I'll start with Henry, who's probably the Dean Emeritus of the private equity space among us here. To start us off with bios.
My name's Henry Obi. I'm the Chief Operating Officer and partner of Helios Investment Partners. We're a $2 billion fund focused mainly on Africa.
Hi, my name is Tosin Runsewe. I'm not the one doing the deal. I'm the one that is being dealt.
My name is Fola Aiyesimoju, and I work with a firm called Themis Capital Management, and we are a very hands-on investment firm that try to take concentrated bets on companies in Africa.
Hi, I'm Asad Naqvi. I'm a managing director at Aiyesimoju Partners. We're a financial services only, or sort of financial services, financial infrastructure focused private equity fund for Africa and Asia.
Fantastic. So the theme of today's conference is about scale and scaling for impact, which is the byword for the day. So most of my questions are going to be oriented towards how we do that from a private equity standpoint. So I'm going to start with Henry again, and I'm going to ask you, what benefits has Helios seen, what benefits has Helios enjoyed from scale advantages that might be employed by its portfolio companies? And does this play a factor at all when you consider target investments?
Yes, it does. For the size of fund we do, we need to start look at large-scale and large-size investments, or we look at sectors that we can deploy a lot of money very quickly. So in 2006, we started a company called Helios Towers, Nigeria. We started it, it's a telecom infrastructure company. We started it from a blank sheet of paper, and we sold it 2 years ago. And by the time we sold it, it had 250 employees and X amount of revenue and so on and so forth. And so without growing that company in a very fast sector, the impact would be, we wouldn't have seen the impact of employment and every tax revenues to the government and so on and so forth. And in terms of looking at portfolio companies or looking at target companies where we look at scale, about some years back, we bought the Shell brand across Africa. That was located in 19 countries across Africa, and we did an IPO last week of that company, and the IPO was very successful. And one of the reasons it was successful was it had a diversified portfolio of companies across Africa, 19 countries. And so without that scale, I don't think we would have had such a great IPO.
Thank you. Coming over here to Asad, why do you think African companies have such difficulty accessing capital markets? And maybe how has this stifled growth? Does private equity solve this problem at all? You know, what are some of these unique challenges that you find growing and scaling some of your investee companies?
I'll take the last part of that first. I guess, challenges in scaling companies. I think, what Henry mentioned, it's important to find a sector or subsector where it's possible to grow very quickly. Just at a basic level, sector selection helps. The challenges, most of the challenges we face are when we're trying to grow across countries, getting the balance right between being local enough to be sort of, have a sort of indigenous understanding of the market structure, regulatory environment, and then balancing that with, some broad principles that can help one grow into other countries. So, not every sector lends itself to that. So, for example, I don't think there's a lot of synergy, there's a lot of benefit to having banks that are multi-country or regional. I think that, that's perhaps a subsector within financial services, what we cover, where scaling without thinking about it is probably not that advisable. And then, so those are some of the challenges, getting the local and versus sort of regional mix right. In terms of why companies have trouble accessing capital markets. I think there's a general access to capital issue, so that's at all levels. It's whether it's at the venture stage or the B stage, the growth stage, or the capital market stage. I think it's more about creating the types of companies that would satisfy capital markets investors, and part of that scale, but part of that's a degree of institutionalization that perhaps some of us on the stage can help provide. But it's about really thinking through what capital markets investors, a particular type of investor, what would be appealing to them, and then consciously building a company in that image in some ways, to the extent that doesn't conflict with other business priorities.
Thank you. Fola, just speaking a little bit more broadly about industries and target companies that you might look at, which ones benefit the most from Africa's growth trends? You hear a lot about Africa growing, about the population size, the demographic dividend. In your experience, what industries and perhaps what types of target companies might benefit the most from those trends?
If I knew the answer, I'd be a much more successful investor than I've been. But I think you've touched on, I think, what the big trend is that everybody talks about, which is population, urbanization, rising incomes. And I think all these things just drive increased consumption. But they drive increased consumption across a whole host of industries: education, entertainment, food, clothing. So I think the kinds of questions we ask ourselves as we try to sort of narrow down and filter down on specific opportunities are things like, if one is focused on scale, which companies or industries are able to serve a broad segment of the population at a price point they can afford? Because it's wonderful to have the demand, but if one is not able to meet that demand at an affordable price point, you can't attain any scale. We then also have to ask which of these things are regionally relevant, because the countries are very, very different across the continent. So Henry talked about retail petroleum products distribution. That's relevant across the entire continent. And I think finally, one also has to ask which of these demand, what are African companies best placed to meet? So if I take things like clothing, if one wants to build a mass clothing business in one of the reasonably poor countries in Africa, you find that you struggle with imports from Asia because they're going to land at a price where that is cheaper. So one has to ask which of these industries and sectors are very structurally competitive to address. And I think when you apply that filter, you find that the universe of investment opportunities gets smaller and smaller and smaller. And when you do finally hone on to one of those companies that meet this criteria, you get outcomes like Vivo.
Absolutely, absolutely. Tosin, bringing you to the conversation now. Now, you work at an insurance company. You help run one of the biggest ones in Nigeria. How practical is it to consider African countries, as markets for the insurance business? What are the winning strategies you've employed? What challenges have you faced building out this platform in the African insurance space?
I work with AXA in Nigeria. AXA is present in 8 countries in Africa. In North Africa, Morocco, Egypt, Algeria. In West Africa, Senegal, Cote d'Ivoire, Nigeria, and in Central Africa, Cameroon, and Gabon. In Nigeria, clearly, Africa today offers a very compelling story for insurance business. Penetration rate is one of the lowest in the world. Penetration rate in Africa is 1.8%. When you look at Africa and you compare it to, for example, a place like India, very, very similar stats. Population, India 1.3, Nigeria, Africa 1.2 billion. GDP size, India I think about 2.3, Africa about 2.1. So very, very similar. And therefore, when you also look at the population, the age, very young age, India I think about 28, average age, Africa about 19, you see that all of the sort of factors you would expect to be in a place that is likely to experience a very high growth there, in Africa. And therefore, we, have a very big focus on Africa. Our business in Africa is almost $1 billion and growing certainly faster than literally everywhere else across the world. Of course, there are challenges. The regulatory framework, is improving, daily, but obviously there's a lot of progress, to be made still. Knowledge of insurance, especially in sub-Saharan Africa, is, quite pedestrian. And so you are not seeing the takeoff, in the way you expect. But there are pockets of insurance business where we're beginning to see decent traction. So, for example, we started a health insurance business in Nigeria 5 years ago. It's emerged as literally the fastest growing health insurance business in that region in West Africa. And today, we are not just serving corporates and individuals within the Nigerian space, but we're now beginning to serve multinationals operating across different countries in Africa. So there are huge opportunities.
Fantastic, thank you. Now, just judging that this is a student conference, and there's a lot of people in the audience I think probably want to learn about private equity, learn about investing. We hear a lot about deals that get done. We all know it's very easy to spend money and buy a company. Asad, I want to ask you what happens once you own the company. What do you do then to create value? What methods of post-investment value creation do you employ? What are most effective? What challenges, what are some of the frequent challenges that arise once you own a company and you're trying to figure out how to create value and unlock value?
Sure. Well, I guess just to start on the how-to part of it. So when we're looking at an investment in the diligence stage, we're also putting together a value creation plan that will guide our portfolio management post-closing. So that's important to be thinking about what one will be doing on the value add side early and in lockstep with the diligence process, and therefore having it be a key part of the thesis itself. And then once the deal closes, we sort of use that value creation plan, that's our lingo, as a sort of map for how we'll undertake portfolio management, and use that to sort of monitor progress on a quarterly basis in our case. So anyway, having a plan early and then tracking to it, and of course it can be updated later as one learns that much more about the sector, is important. In our case, we're a sector-focused fund, so we should be doing a lot. we should be quite helpful to our companies, and what we typically do is there's always some element of management augmentation, supplementing the team. There's often an element of technology and technology enhancement. There's often a big growth agenda, which is either some sort of product expansion or geographic expansion. What we're starting to do more of, as now that Fund 2 is about to launch, as well as a few other vehicles, we are looking to sort of productize our value creation much more, which is have sort of areas such as, a number of our companies are starting to launch credit products. Let's say a merchant acquirer that's starting a merchant cash advance product. So we're starting to build particular expertise in areas like getting somebody, an institution, a company that's not providing credit today, up the curve quickly. Data and data analytics and the sort of organization that goes with it is another such area. So we're trying to productize what we do on value creation by having specific areas that we can offer companies sort of focused expertise on. But I'm sure that's different for everybody on the panel, but the overall message is you need to have a plan day one on how to focus your value creation efforts.
Yeah, following right along to Tosin, you're a company that has private equity investors, so maybe you can talk a little bit about, on the one hand, what your views are around the trends for further acquisitions in the insurance space from financial investors, maybe why PE hasn't gotten involved in the past before, and what you're doing now to create value for your investors in the insurance business.
We had private equity investors and European development finance institutions in our business. They entered, the first actually made an entry in 2006 and then increased their shareholding, and then the others entered in 2011 and all exited in 2014 to a strategic player, the biggest brand in insurance world. What we have seen is on the back of this deal, we've seen a lot of interest from quite a few insurance players. So I'm not sure that I actually agree that, maybe they're not as many. So we've seen, all of the players who are in our business either entering or about to enter other businesses. We've seen the likes of Leapfrog Africa, Capital Alliance, all, have made, an entrance, into the market. And I think the key thing is everyone keeps looking at the penetration rate. So the headroom where insurance business in Africa is concerned is really significant. At 1.8% compared to the world average of maybe 6.5%, there's a lot of room, for growth. So I think that we will continue to see a lot of attention, coming into this particular space. Of course, a lot will depend on which particular market they are entering and how they can scale either within the particular country or across Africa. I think these are the factors that will really determine who's going to be successful.
Okay, great. Now we talked a little bit about how you create value in owning a company, but the sort of the magic of making money in this business is obviously exits. So maybe we'll start with Henry, who has a fair amount of experience with exiting successfully. We all know that the continent has shallow bourses, difficult access to capital market, limited number of investors focused on Africa. How do you combat all those factors to make sure that you navigate successful exits for the investments that you do make?
I think it comes back to your first question. You've got to find a scalable business to do either to sell to a trade buyer or to sell to do an IPO, and it really depends on the scale of the business. But as well as the scale of the business, it also depends on the value creation that you put in. So when we go into a business, we look at three things: the organizational structure of the business, and if there are any gaps, we employ one of the top headhunters to fill in the gap, finding the right person globally to fill in the gap. And I think that's one of the slight issues of many parts, not only Africa, but many parts of the world, where you're trying to find the right management team to put into the company. Second thing we look at is pricing, looking at the pricing structure of the products the company sells. And third, we look at what GE has done for a long time, which is called Lean Six Sigma. And we've got a couple of Lean Six Sigma specialists that look at the company. And wrapped around that is really the corporate governance and what we call ESG of the company. There's always a premium. When you sell a company, there's a premium for good governance, and that's really important to us. So tying all those things up in a great market and a scalable business, well run, and you can have a story to tell. The real thing is really telling a story. If you continue to educate potential buyers that this is a company we just bought, we bought it at X, and now we've scaled it in terms of EBITDA to 10X, then it's a compelling story without any regulatory hindrance. So once you've done all those things and ticked all those boxes, then the IPO tends to be more successful than others.
Okay, thank you very much. Fola, what are the main impediments that you see in scaling companies that you look at in terms of making sure their business models can enjoy intra-African scale? Is it sort of policy? Is it logistics? What are the real challenges to making a business scale?
I think from what I've seen, there's a lot of excitement in growing and selling more, but not many companies focus on building the guts of the company to support growth and scale. And so things like what Henry mentioned is the boring stuff. Do I have the right org structure to support scale and growth? Do I have the right risk management processes? I mean, you'd be terribly surprised how many CEOs you speak to who don't think about risk. They assume nothing bad is going to happen. Do I have the right distribution? Can my production facilities scale 5 or 10x? And I find that people don't spend enough time thinking and investing in these things, and they focus more of their effort on the more interesting stuff, marketing and sales, and that's where they struggle to. You find you achieve relatively good early success, and as the business that's getting more and more complicated as it scales, companies cannot just move on from that level to become truly sustainable large businesses.
Thank you. All right, we'll open it up to the audience now. If anyone has a question, they can just raise their hand. I think there's something I'm supposed to do with this tablet, which I'll figure out while the first person answers the question.
Hi, Ed Stevenson, Goldman Sachs. One of the key kind of differentiators for private equity houses in Africa versus elsewhere appears to have been the ability to borrow in large amounts, or rather not in Africa often. I was wondering whether, as we hope, capital markets may deepen, bank lending becomes cheaper, whether you think that will transform the way that you look at the opportunity set within Africa.
In business school, they say debt's cheaper than equity, but unfortunately in Africa, it's the other way around, as you well know. And in private equity, there are three ways you make money. One is through multiple expansion, two is through earnings growth, and three is through leverage. Unfortunately, in a lot of parts of Africa, we don't have the luxury of leverage, and so multiple expansion is really exogenous. So all you're focusing on is earning growth, and that's why this value creation and really having the right kind of people to mine the company in terms of operational excellence is key. We are seeing slight movement towards, we've done it quite recently in a number of portfolio companies where we've done a recap, where we've been able to take out some slight leverage and then pay distributions, dividend distributions back to investors. But unfortunately as well, you well know, you've got to match it. If you've got a company that's a dollar-driven revenue company, then it's okay to lend to borrow in dollars. And so you've got to match the currencies as well. So I think over time, we'll see more leverage. It really depends on the environment and the currency stability of a lot of the macroeconomic environment in Africa. So, but there's still some time to come on that one.
Yeah, and just to add, it depends on the type of opportunity. So we're a growth equity fund. We're not doing buyouts. If debt were more easily available, maybe we would think more about that. But there's other issues there. There's sort of the sorts of company you get, the sorts of companies you come across that are willing to sell control. It's a different sort of group. But in the growth equity world, I guess one doesn't count on it. It ends up being gravy if you can, over time, add some leverage to the company. It's starting to happen in some subsectors, right? We recently invested in an off-grid solar financing company. It now has term sheets for about $90 million, mostly local currency funding. So that's because it's a hot sector. It attracts concessionary lenders, but hopefully that's step one onto the company accessing more sustainable market-based funding, but it's an important step one. So, things change, but I think for now the imperative, as Henry said, is on growth and making sure that the growth is dramatic enough that it can ride out whether it's currency volatility or lack of debt financing and other issues. So to us at least, it's all about growth and using in the absence of other ways to juice returns. Yeah.
Oh yes, sir, in the back.
Hi, George, Credit Suisse. So 2016 or 2017 saw a record amount of dry powder in Africa. So I just wanted to know that is the pipeline of investments matching this dry powder? Do you see this picking up soon? And what do you think are the critical aspects that need to improve in the market to be able to see more deals happening?
Yeah, I think globally, there are record levels of dry powder, which I think is probably attributable to private equity success as an asset class that has delivered superior returns over time. In my experience, I used to be an M&A banker before I moved into private equity. There are deals. But I think in Africa, the deals are not, you don't have a sophisticated and intermediation framework as you have in the West. So I used to work with KKR, and a banker would come to you with a perfectly laid out opportunity, and you priced, and if you liked the pricing, you invested. In Africa, you don't have that level of sophistication from an intermediation perspective, and I find that managers who are willing to go hunting, there are enough deals to do. So I'm not worried about the quantum of dry powder. It's more about the creativity of the managers to find the deals.
Yeah, could I just come in as well? I think there's a fallacy that there are no deals on the ground. I mean, who knew a few years ago that Louis Dreyfus was going to sell his business in Africa? You folks sold it to us. So, there are deals on the ground.
I think sometimes also some of the deals that have been done tend to be, relatively small, and therefore they're not eye-catching, and so they're not really reported widely in the press. But I think there are lots of, small transactions, going on, all the time.
Let me come in and violently agree with everybody who's just spoken. But, I think there's lots of investment opportunity, and they may not be perfectly packaged deals, but I think that's up to the creativity of the manager, basically to create the deals, and whether that's a roll-up in a sector that has a lot of white space. We recently have put together, several payment service providers to create a sort of regional platform that hopefully one day PayPal will buy from us, or a company like that. But the idea is there wasn't a single company that was doing that at scale, so we put several together to create a leader in that space. So one creates companies into the opportunity, and I think probably everybody on the stage has a story or two like that.
I think what you're touching on is that private equity in Africa is a very different animal than anywhere else. I think everyone here will agree. And you have a situation where you're sort of a hybrid between a financial manager and an operator in many cases. I think everyone here will agree. You will take on operating aspects of your portfolio businesses you didn't intend to do, and that's how you find success. I think Asad is sort of hinting at that, and I think that's what he means by creating deals. You sort of, the deals that, we're still in fundraising mode effectively, and we have a pipeline over 100 opportunities. Now, the difference is, when I was sitting in New York at a big comfortable bank, these weren't deals you would look at, right? But in Africa, these are the deals, right? And the opportunities are there. So I think that's the disconnect some see between sort of there's no deals or there's too much money chasing deals. Ask the guys on the ground begging you, sending emails out of the blue, and they'll have a very different story for you. Sir.
Hi, my name is Simbara Shemongo from HFG Agriculture in Zimbabwe. And I've got two questions. Number one is regarding family-owned companies that have the value propositions that you guys allude to in terms of PE and multiples and potential exit opportunities, vis-a-vis the reluctance of family-owned companies to let go of equity or convertible options, and the need for you to go and delve deeper into their companies from an operational perspective in order to derive that value, and how you're managing that. And then as far as the second question is regarding sort of one of the transactions you alluded to, the Lewis Dreyfus transactions, the fertilizer transactions. How, agriculture is clearly a scalable area on the continent, but because you don't have enough sort of history of tenured land or title towards that, how are you sort of managing that? Because without being able to unlock that, it's difficult for the upstream industries or downstream industries to derive value.
Have some experience personally with family-owned business in Africa, and we're in the manufacturing sector where many of the businesses you'll find are family-owned and typically migrant families, so Lebanese, Indian, et cetera. And there is a large cultural barrier to inviting in a financial partner. And I think some of it is the soft skills you learn. I mean, it can take a long time to originate a deal because you have to sort of sell the value add to the seller. And a big part of it is sort of creating a story, a vision of where you're going or where you want to go with the company, and explaining how you can do that in a way that maybe they would find difficult. A big part of it is also making sure, so we don't do any buyouts, so we keep the seller involved, and so, many times the kicker for us is that they're going to enjoy some of the upside that we bring to the table. We're not going to walk away having made a lot of money and left them holding the bag. Anyway.
Yeah, there are two things. First is one of the newest asset classes to Africa is now private credit. And private credit is growing very quickly in recognition of what you're saying. Family businesses do not want to sell to private equity players because it's a taboo to lose your business or pass on your business to external people. And hence, the private credit world is really growing very quickly. Secondly, is that unlike family businesses in the West, where family members go on to LA and the UK and one member stays in Africa, after some time, they get tired of making money for the others who have a lifestyle. And so we've had situations where they've come to us to price their business and then go to the other family members and say, I'll buy you out at that price. So private equity players almost set the price for the family members to buy themselves out. And then just to your agricultural question, the business we bought, Louis Dreyfus, sells fertilizer and seeds to farmers. So it doesn't involve itself in tilling the land.
I think I'll just add that there's not one size fits all for private equity. And I think many family-owned businesses, and frankly, many corporates, have had bad experiences with some private equity players where they're promised wonderful value creation plans that don't materialize. And they find out in year 5 that there was some put option at 2 or 3 times their money, and they tell all their friends never touch these people. So I think there's a lot of educating that the private equity community needs to do with family office and the general sort of corporate landscape, that if you partner with a private equity firm, the theory should be you should together create more value than you could have created for yourself. And I think where you are able to credibly sell that story, you find there's a business people, you find decent reception.
In financial services, I think some of the transactions I've seen done in Nigeria, have had a very long tail. You spend, quite a bit of time cultivating, the family, building trust, building relationship, really explaining, how you intend to create value for them, being transparent about the value you're creating for yourself. And in some of those cases, I've seen, minority stakes, being, given at the beginning. And as, the relationship grew, more and more equity, is being given out. And also sometimes, as perhaps the founder of the business also gets older, and perhaps his kids are all over the world and they're not really interested in the business. You're there, you've been there for the last 5 years courting him, you've been there for the last 10 years talking to him about the business, and then one day the opportunity opens. So I think it's not a sort of relationship where you just look at the deal, whether it's happening or not, and then you go away. I think it's something you have to invest time and effort in.
Can I just say one more thing? The problem is as well for private equity players is that looking at family businesses, sometimes it's more trouble than you ought to be involved in. They have like 3 sets of books, uncle, father, daughter, all employees of the company. So when you take it over, who do you fire? So.
Hi, Matt Close, Deutsche Bank. Sorry, it's starting a bit like an earnings call. So I'll add that I'm an aspiring impact investor in VC. In terms of impact, to what degree is that an investment criteria when you look at Africa? Or is any investment in Africa for you considered impact? Do your investors have any criteria linked to that? And do you report on the impact that your portfolio companies have? Thank you.
I would say there's so much in the news about impact investing, and I think it's old wine in a new bottle. DFIs have been doing impact investing since time immemorial. Yes, we invest to make an impact. We're not impact investors. So the businesses we buy and scale up, employ people, pay tax to the government, and so on and so forth. But then we do look at sectors that, for example, we own the largest InterSwitch, which is a transaction payment system in Nigeria, Switch, and that assists in financial deepening. We also own a payments business in Egypt. And then on the solar front, we have two what we call energy renewable access businesses. One's a solar business in Tanzania, which is teamed up with Elon Musk and his entity Solar City, and they're producing solar lighting for residential customers. And then in Nigeria, we just started a company and this is what I'm talking about in terms of businesses where you think you can put a lot of money to work. This company provides solar energy to businesses in Nigeria, mainly the petrol stations and the banks. It swaps out the energy-intensive solar systems for energy-efficient solar systems. And so that is a form of impact investing at the same time. But our main focus is really making money for investors. And I always say that in a bull market, everyone wants, different products. In a bear market, you can lose all your money and you say, hey, I'm an impact investor. They're not going to invest in you again.
Asad?
Yeah, I mean, it's a question of definition as well. So that's Henry's, laid out his view of impact. So there's a spectrum, right? And there's people for whom the return is paramount. There's people who try to balance both. We like somewhat similar to where he is. Financial inclusion for us is core to our mandate, is core to our investment process. But we don't call ourselves an impact fund because we don't want to imply any trade-off with returns, because that's not what we believe. That said, we absolutely think there is not only an impact, there's a lot of impact to investing in financial services in these markets, but there's a commercial opportunity in broadening the reach of the financial sector, which today probably covers mostly large corporates and the affluent, to cover a larger swath of the sort of population, the mass retail segment. We think that's super impactful, also very commercial, and most of our investments are, most of our investment theses are focused on that, on the expansion of the formal financial sector, which we think over time reduces the cost of financial intermediation, the cost of transactions, connects more people to the formal economy, and is quite impactful.
Something that's very important that gets lost in all of this is that, Africa is probably the least attractive investment destination globally for capital at the moment. And I think changing that by helping people make a lot of money in Africa is extraordinarily impactful. So, the focus on the bottom line has to be there, primarily because we need to tell the story that there's money to be made in Africa so you can unlock, the hundreds of billions of dollars that are sitting elsewhere. Number two, our perspective at our firm is that we do consider ESG as a KPI. And the reason for that is, and I found this, and my partners have found this in prior careers, is that if a company is doing a very good job on their environmental sort of aspects, if they're treating their effluents and waste well, then their governance is probably pretty good. So for us, it's an indicator of good governance, and we do consequently report on it.
Hi, my name is Valentine, and I'm doing my MBA at Oxford, and previously I was in private equity in Nairobi. So my question is around structure, and you guys have talked a lot about how private equity in Africa is a very different animal. So, you have to create the deals, the origination takes a long time. How do you sort of balance this with the traditional 10-year structure where you have to return funds and make a return in a short time, whereas the actual value creation process is much longer than we've seen in traditional markets?
Given the constraint of a 10-year fund life, which means you have to think about exit at least by year 5, if not earlier, depending on where you are in the cycle, I think one needs to be thinking about exit from the get-go. So the same way I spoke earlier about thinking through the value creation plan before the investment, one thinks about the exit before the investment closes, and in the phase when one is developing the investment thesis. So that may involve, for example, talking to prospective buyers of the company for the target you're looking at before you do the deal, to see if, in 5 years, with that much more scale and maybe that much more of a regional footprint, it would be attractive to the likely buyers. So thinking about exit from the get-go is one way to, make sure you're working within the parameters set by the 10-year fund life. The problem with different structures, and lots of structures get talked about, is investors still today only really are set up to analyze and commit to the traditional structure. So if you're trying to do something different, it can take an incredibly long time to raise the money, structure something, etc.
You also talked about the length of time it takes to do deals. And I think it's not a uniquely African problem. I think you need to balance speed of deployment and return. So if you want to deploy very quickly, ring up all the banks, they'll send you the books and pay the highest price in every auction, and you deploy your fund reasonably quickly, but then you dilute your returns. So it's just balancing the tension between speed of deployment and trying to find quality deals. And I think also going into business with a clear thesis and agenda. What kind of deals are you looking for? Because not every deal and every sector is for everybody. and the clearer you are in your mind about what you're looking for, I think the more quickly you would narrow down on the specific opportunities and then try to convert those into actionable deals.
I think those that sometimes have more success are those who have a very clear plan even before going into the transaction. So for example, if you're going into a sector where you know strategics are looking at within Africa and you know they're making an entry one after the other, then in going into that business, you probably just want to really create some value. Either you improve the profit margins, you grow scale a little bit, you strengthen the technical expertise of the team, and essentially just clean up the books and position the company. You'll be out in 3 to 5 years. But if you don't have a plan, then I guess it becomes a bit more difficult.
As an alumni of London Business School, why are you at Oxford? That's in all seriousness, you have that question's really valid, and what you're seeing globally, and in the US and the UK, you're seeing holding periods go from 5 to 6 years. In Africa, because of all the things you said, you really have to work on the company and fix it and then get it ready for sale. That takes 7 to 8 years. And so a lot of people that fund private equity in Africa, both the GP and LPs, have realized this factor, but that by the time the company is really primed to go, you're selling it and you're going to leave money on the table. So some of the DFIs have got together and funded the first permanent capital vehicle. And I think that's going to be a trend where you're going to see more and more long-term vehicles for African investments.
Coach, I'm Godfrey. I'm a hedge fund investor. One thing that I find interesting is that there seems to be a concentration in investing in the larger tier companies. So a lot of PE firms will invest in larger size, around $100 million, because they raise big funds and it makes sense for proportion. Do you see a difference between investing whether in the larger type companies or in the smaller ticket size? So let's say 100 versus 5 million. And also this one, definitely just for Tosin. Given that you've now been acquired by a foreign player, do you have to comply with international regulations, things like Solvency II? Thank you.
Today, I believe in most parts of Africa, the answer would be no. But within the financial services sector globally, I think the regulatory framework is converging, and therefore it will be a question of time. And if you're being acquired, for example, by a strategic that's European-based, then literally from the beginning, they get you through the risk management framework to start to tailor your processes and your practices towards being able to arrive at Solvency II within a very short while. So it's not really required from a regulatory perspective in most African markets today, but it depends on who is buying. So if you have, if you've been acquired by PE firms, it might not be, very high up, on their priority list. They have, other things they want you to do in order to position you for sale. But if you're being acquired by a strategic, then that discussion comes up daily.
You touched on deal size, and there are multiple perspectives, but I have two as to why I would personally lean towards larger ticket and smaller ticket. I think fundamentally, private equity is asset management, which is a scale business. So it's much easier to build scale by doing larger transactions than by doing smaller ones. Just the return on effort is greater. And even from a value creation perspective, if you bought into a business that was, let's see, you mentioned $5 million, you paid 10 times, let's call it a $500,000 profit company, you would find tension with your partners, whether it's a board or a CEO or a family, when you're discussing the investments required to improve the business. Whether it's let's recruit a world-class head of risk and compliance, that person's salary can swing that company from a profit to a loss. So I find that larger companies are actually better able to absorb the toolkit that an investor would want to bring in to improve the company than smaller ones.
Yeah, and just to offer the counter narrative, because we do sort of operate in the minnow side of the pool, is that obviously in a place like Africa, there's just a lot more deals at the smaller end side of the market, and therefore, and fewer people navigating for the exact very good reasons that Fola gave. which is, yeah, you know, life's too short. You know, do you really want to deal with Oga at his $500,000 a year company? Maybe not. But the difference is, since there's no one else showing up, you get to sort of name your terms. The valuation dynamics are a little bit different, and you can actually create quite a bit of value in a short span of time. The companies in Africa that are 100 million plus are, you know, we all know who they are. The guys who run the company know the president. You know, it's a little bit of a different ball game. Last question, I think, because I think we're running out of time. No, okay, we have a few more minutes. Question from the audience, though, on the handy-dandy tablet. How do you manage exchange rate risk? This is obviously the million-dollar question dealing in Africa. Most of us are funded in dollars or some sort of hard currency. We're buying, in many cases, local currency revenues. How do you make that, how do you circle that square?
You don't. It's too expensive to hedge. Ideally, you find companies, if you have a dollar fund, that have sort of a natural hedge. They make their money in dollars somehow. Their revenues in dollars, so that always helps. Short of that, you know, it's a mix of portfolio construction, making sure at least some of the opportunities that you're going after have some sort of hard currency angle to them, making sure that depreciation is fully factored into your pricing, so it's in your model in a sufficiently conservative way, and you can count on growth above and beyond, you know, what the interest rate differentials imply in terms of annual currency depreciation. So that's super important, not to be surprised by it and to price it in actively. And then whenever possible to structure around it. You know, hedging can be expensive, but there are other ways, you know, creative ways to go about it. You know, taking a local loan to buy a company backed with dollars held offshore, et cetera, et cetera. So there's a structuring component as long as it is reasonable in terms of cost. But mostly it comes down to, at least for us, a mix of portfolio construction, appropriate pricing, and actually discipline to stay away from opportunities where, you know, where a big currency shock will wipe you out. And I think you have to count on at least one of those over your whole period.
I guess we've all seen what happened to a very large telco operator in Nigeria, no names. So I think this is a very difficult situation. I'm not going to be able to speak for the PE firms, but I'll give you one example. In our company, we are actually about to build a hospital as part of our health insurance offering, and it's a $4 million transaction. We've been able to raise equity. Equity was quite easy. We're leading a consortium of 4 investors, 2 European, 1 European DFI, IFC, and one private equity firm. And we have lots of offers for the debt in dollars, but obviously we're not taking any, 0. The whole of last year, Nigerian banks, you know, were lending, as you know, to the government, buying government securities, and nobody was interested in financing, you know, any deal. So we've had to wait for a year, and it's because we have insisted that the funding has to come, you know, in Naira. Otherwise, everything, you know, would really be upside down if there was further devaluation of the currency. So it's very difficult, you know, for us. I cannot imagine what it must be like, you know, for this gentleman.
I guess that's why private equity in Africa is gagging for 2 things. One is for insurance companies and pension funds to fund us locally, so that we match assets and liabilities. And secondly, for Credit Suisse, Goldman, and Deutsche Bank in the room to come up with a product that will be priced at the right level for private equity in Africa.
Fola?
Yeah, I just had thinking about currency. I think there's the investing component, and then there's the operational component. On the investing side, I think Asad has touched on most of the key points. In your underwriting, you cannot deceive yourself. If your business is growing at 10 or 15% in Naira, and you pay full multiple on that business, you're not going to get a good return because the devaluation is going to eat up your return. But I think operationally, there are things that one can look out for. If a business imports 90% of its raw materials, you are going to have gross margin compression as the currency devalues. So businesses that have domestically sourced raw materials, again, are slightly more attractive. Are there opportunities to manage your treasury so that you keep a component so that when there's no availability, because sometimes it's not about the price of the FX, it's just not available, you're still able to stay in business? Are there intervention funds where you can borrow at 10% from a central bank? You get as much as you can get. So there's no knockout blow. But I think there are many operational things that one can look out for to at least mitigate some of the harm that devaluation causes.
Okay, I think this is going to be the last question. So maybe each of you can go around and just give a one-sentence answer to this, because it's an interesting question, but it's a difficult one. There's a lot of demand for finance in Africa, but not a lot of investors. How do we increase the interest of investors in Africa, whether it be LPs for us or other firms investing in African markets?
Local pension funds, insurance companies need to invest in the asset class. We raise most of our monies from the US, and if US investors can invest in Africa, then domestic pension funds should invest in Africa.
Hear, hear.
I think the PE community needs to help small African business structure properly, improve their accountability, improve their corporate governance. There is the Goldman Sachs 10,000 Small Businesses program here in London, where they're partnering with 3 business schools. I think such a program would improve the outlook of small businesses in Africa, and therefore improve their attractiveness, to investors.
Fola?
I think just more success stories. The more attractive the returns that people who've gone in first get, the more encouraged others are going to be to follow.
Asad?
Yeah, same thing. So if we all do our job, produce good returns.
And I will echo those last 2 comments. One of the fun things about being in private equity in Africa is, unlike New York and London, where I've worked before, where you sort of have your guns out at each other. I mean, it's actually a very collegial industry, because we all want each other to win. Because if these guys do very well, it becomes a lot easier for me to raise money. So anyway, on that note, please thank our illustrious panel for their insights.